Hi, I'm Jen from OpenMarkets and I'm here with Andrew Coloretti and Jeff Oughton from Giles Wade, and we're here for another investment update. So welcome guys, thanks for talking to us. So Jeff, financial markets have taken a bit of a hit lately, particularly the Australian equity market. From an economic perspective, what's going on and what's the outlook for the next 6 months?
Well, the economic outlook is still a little slow and uneven and a little risky around the world. The US is recovering, but China's slowing down, and in Europe there's a few geopolitical risks around that Greek exit. And when you get back to Australia, here Australian output is still sluggish too, because the mining boom or the mining investment boom is still coming off, and the household sector and the public sector aren't taking up that slack. And when you overlay on top lower commodity prices, cash flows in Australia are very, very sluggish. So that's seen the Reserve Bank cut interest rates again, and it's made people reassess the outlook for returns on equities and bonds as well in the last few months. And it's been a bit of volatility around that repositioning.
So on returns, what is the outlook, and in particular for cash, bonds, shares and the Australian dollar?
Well, if you start with cash, the Reserve Bank's lowered interest rates to 2% and was getting close to the bottom of the cycle, albeit you can never say never. So we think 2% is probably the bottom of the cycle, and bond rates are now starting to rise as the Fed starts to tighten, is expected to tighten US monetary policy, and so that yield curve is steepening and returns from bonds are turning negative. And then if you look at equity markets, because they're sort of still struggling to work out where we're going, they're taking a bit of a breather, and I think you're going to get good yield returns from those good companies, good dividends, but the capital gains of the last few years I think are going to be much more modest. Importantly, this Aussie dollar has got to go down further, and that's going to be brought about by the lagged effects of these lower commodity prices, or indeed the Reserve Bank having to cut interest rates again. So the Aussie dollar probably heading towards 70 cents and more modest returns overall, and probably better returns from offshore than onshore.
And Jeff, what are the key risks over the next 6 months, such as the China slowdown or the US tightening tantrum?
I'm not so concerned about the Chinese slowdown, because the authorities there have plenty of scope to cut interest rates and also to pump up the economy with government spending if the need arises. I think the main thing to watch here is the US Fed and how quickly they raise interest rates here. It's a fine balance. If they raise interest rates in a patient manner and growth keeps on going, that'll support equity markets and that'll see a continuation of being well positioned in equity markets. But if it becomes disorderly and bond markets sell off dramatically and that spills over into growth and into emerging economies, that'll make the whole world economy become more nervous again and weigh on equity markets as well.
And Andrew, in your previous presentation, you spoke about how asset allocation is a major driver of performance.
Yes.
So how have your views played out year to date, and what changes, if any, have been made or are likely to be made?
With asset allocation, we've planned, not much has changed. Just recapping, 3-4 months ago, we lifted our allocation to international growth assets, in particular equities, trimmed our domestic equities. We lifted our fixed interest slightly out of cash into high yielding instruments, and also we increased our exposure to alternatives, in particular offshore. So not much has changed. We still believe the thematic is very much growth offshore. Australia is below trend growth. On the back of Jeff's point about a softer or a weakening or a further weakening Australian dollar, we still think that predominantly an unhedged international exposure is positive, and we've derived some good upside and performance. The Australian market headed for a great opening. The first few months has come off and basically given back all its gains. Whilst cash rates have fallen, people are still chasing yield. Our view about that is that we've seen this before with the yield trap, where customers or investors chase yield in companies where traditionally have paid well, but payout ratios are under pressure, balance sheets are under pressure, and any sign of a reduction and or cancellation in dividends is hitting both the capital and obviously the income. So you've got to be wary going forward. I think particularly with the Australian domestic market, we still believe that good quality instruments in the fixed interest market with floating rate notes on the back of Jeff saying that the cycle is likely to turn into 2016. But overall, it's pretty much the same. Increasing international, trimming domestic equity or growth assets. Property, just be careful in the property market with REITs, particularly retail. Alternatives, we're still lifting, albeit small, our exposure, and obviously cash will continue to underperform. So overall, much of the same, and I think it'll be a challenging time ahead.
Great, thanks for talking to us today, and we look forward to the next update. Thanks for watching, everyone.